Hello, everyone. Thank you for joining us today. We're hosting this webinar in partnership with Mark Chandik from Prosperity Partners to present Life Settlement, Creating Value Out of an Existing Life Insurance Policy. Mark Chandik is a partner with Prosperity Partners Private Wealth Management in Irvine. Our firm has worked with Mark and his partners for several years. Mark has over 40 years of experience in wealth management and specializes in working with owners and operators of privately held businesses. Prosperity Partners is one of the largest independent settlement advisors in the West Coast and one of very few in the country with over 20 years of experience in the industry. Mark is going to help us explore the world of life settlements and the benefits of creating value out of existing insurance policies. During this presentation, you will learn what happens or what options you have for existing insurance policies, the process of completing a life settlement from the introduction of the concept to receiving the proceeds from the sale of the policy, and what factors determine whether you are an ideal candidate where a life settlement could be the solution to help with policies that you no longer need or want. At the end of the presentation, we'll have an opportunity for a Q&A. So you may submit questions through the Q&A feature. And if you have any technical issues, please feel free to put those in the chat or in the Q&A, and either myself or Melissa Cardinelli will reach out to you and we'll assist you with what we can. Without further ado, I'm going to turn it over to Mark Chandik to start the presentation.
Thank you, Paula, and welcome everyone this afternoon. Life settlements is a very, very interesting subject, I think, given the demographics in the United States right now, with aging of America and a lot of life insurance policies sold, yet perhaps not needed. And I think that a good way to begin today is to understand where life settlements began. And that was during the AIDS crisis, when we had a lot of very, very sick people in the United States that were terminally ill, unfortunately, and had huge medical expenses. They owned life insurance policies, and what they ended up doing was negotiating with the insurance company to advance all or a part of their death benefit to them while they were still living in the last year of their life. That particular transaction was known as an accelerated death benefit, and now that is contained in every life insurance policy. So if a person is terminally ill, expected not to live more than 12 months, they can advance pretty much the entire amount of their death benefit to help with expenses. So that was the birth of life settlements. Life settlements then grew from that concept to being able to sell a policy to a third party. So today's session is going to encompass a number of different topics. We're going to start with what is a life settlement, a little bit about what the journey looks like if you decide to sell a policy. We're going to talk a little bit about several processes available to value a policy to see if, in fact, it is marketable. Some of the pros and cons. We're going to look at some case studies of actual policies that have sold and some that have not sold. We'll look at a timeline for this type of transaction, and then we'll kind of wrap it up. So that'll be the way that the day unfolds. So I think the first thing to think about when you think about a life insurance policy, it is a financial asset. It's a capital asset, just like a home or real estate, stocks and bonds, and or your retirement account. And there is value created with that policy, just more than the traditional sense of a death benefit or perhaps cash value. And so what we're talking about is a different type of value that is available or is available by purchase by a third party. So a couple of facts about life insurance in general later in life. Most people don't realize this, but 88% of universal life policies never result in a death claim. The point here is that permanent life insurance, universal life as a cash value policy intended to last for life, 88% of them do not result in a death claim. They're either surrendered most likely surrendered before a death. 85% of all term policies never result in a death claim. So these policies are being surrendered at a very high rate and actually never do result in a death claim. Believe it or not, 20% of people that own life insurance policies that are over age 65, the value of their policy, if they were to sell to a third party in a life settlement transaction, is greater than the actual cash surrender value of the policy itself. This is a growing marketplace. Every day, more than 10,000 baby boomers reach age 65. And the sweet spot for selling a life insurance policy is in your late 60s and 70s. Additionally, less than 1% of the population, I know Paula knows this well, are not subject to estate taxes currently with the very high exemption amount. So life insurance that may have been purchased as part of an estate planning strategy inside of a trust may not be needed anymore. And so disposition of that policy under a life settlement is a potential. It is a huge industry. Back in 2021, $154 billion was transferred from life settlement companies to insureds, and it continues to grow. I will say that years ago, it was the Wild West. I'd say about 20 years ago, there was very little regulation, and there were some questionable characters out there. Today, it is highly regulated, especially in California. Anyone that even discusses a life settlement, that's an agent, that's a life insurance agent, has to have 15 hours of continuing education and 2 years of practical experience. So not everybody is doing the transactions. The capital markets right now are very robust. Most of the companies that are buying life insurance policies are looking for what they call a hurdle rate of 7% in a portfolio that they're creating when they're buying policies. So there's a lot of money right now available to purchase policies. It's a very robust environment. And I say contrast that with 2008 or 2009 when we had, of course, the beginning of the Great Recession. All the capital in that market dried up. You couldn't sell a policy if you wanted to. So let's start with why you might consider selling an existing life insurance policy. And there's really, as this graphic indicates, there's two reasons. On the left-hand side, it might be life insurance that you need to continue, but at a different amount, perhaps. And then on the right-hand side is you don't need it at all going forward. So let's take the left-hand side. So it might be, for example, you own a life insurance policy protecting your family for income replacement. And now you're retired, you still like to own some, but you don't need as much. So you could do a partial settlement, sell a portion of that insurance. The second reason is that premiums on many policies are rising. Term insurance for sure will go up, but also on cash value policies that projected benefits for lifetime because of low interest rate environments and other factors, you may find that your policy, in fact, is not projecting for lifetime. Therefore, premiums have to increase, and you may have an affordability issue with those higher premiums. So one of the options to sell, again, all or a part of the policy. The third reason is that in your estate planning, you may move from an individual policy design to what's called a second to die life insurance policy design for, let's say, insurance held in an irrevocable trust. So it's just, you're going to employ a different strategy. And so you will want to sell one policy and purchase a different policy. The next reason is you might have a situation where it is less expensive to insure the other spouse. The other spouse might be female, younger, healthier, and it would be less expensive. And so you want to abandon a policy, let's say on an older male, and purchase on a younger female. Funding new insurance. Again, you may have a policy that you want to sell because it will be the funding source for something new, a new strategy. And finally, term insurance. Many people don't realize that you can sell your term insurance. You can convert part of it to permanent insurance and sell part of it, or a bunch of different combinations that make sense for you. On the right-hand side are reasons that I find that people no longer need the insurance at all. One is you may have had insurance that was part of your business to provide liquidity, and you sold the business, you had a liquidity event, you really don't need the policy anymore. That certainly is a reason to sell. The estate value is decreased. You've done a great job working with Paula to mitigate estate tax, and you've done gifting and other strategies, and so your value of your taxable estate is decreased, and you no longer need the amount that you needed previously. If you're a company or a business owner and you own insurance on your life as an executive, or have insurance on other executives, and they retire, then those policies could certainly be sold. Buy-sell funding would be between partners of a closely held business. Very typically, life insurance is purchased on 2 or more owners. In order to ensure a buy-sell agreement, that agreement may no longer be needed, in which case you could sell the policy. Liquidity issues of clients that say, look, I'd like more cash in my estate. I don't have enough. I'd like to go ahead and sell and have some additional cash on hand. And finally, there might be an opportunity elsewhere for investment, and so you'd like to sell your policy and have that capital available to deploy somewhere else. So there's lots of different reasons that people look to sell their insurance policies. So what makes a good life settlement? There are demographics that are important in this particular area. First, and these are not hard and fast rules, these are just, I guess, generalizations, because I have done transactions outside of these demographics for sure. But typically age 70 and over with significant health impairments. In other words, their health has declined since the time the policy was purchased. At the time that the slide was put together, the life expectancy of a person selling a policy, most of the funders or buyers wanted a 14-year or less life expectancy. That ebbs and flows. It is now closer to 10 years. But we still sell policies that have longer life expectancies, but I have seen the life expectancy requirement of buyers go downward, down towards the 10 years or less in life expectancy. And of course, the last thing that requirement of good settlement is, again, somebody that's decided they do not want to keep it. What about the policy itself? There is a minimum standard industry-wide, $250,000 minimum death benefit. Higher is better. $500,000 or more is better. The market is very available for death benefits up to 10 million. As you get higher than 10 million, some of the buyers and the players in the arena start to back away. That's a little bit too much for them. But no problem up to 10 million for sure. I mentioned previously that all types of life insurance policies are available to be sold. That's universal life, guaranteed universal life, survivorship universal life, indexed universal life, variable universal life, convertible term, and whole life. So any type of life insurance for the policy, with the exception of group term insurance. So if you're covered by your employer and you have some group term there, that is not a policy type that can be sold. A rule of thumb as far as pricing is that the premium that you're paying on the life insurance policy, it becomes more difficult if the premium is higher than 5% of the death benefit. So if there's $1 million death benefit and the premium is $50,000 or less, then that is more viable than if the premium is higher than $50,000. If the policy has a cash surrender value, lower cash surrender value, believe it or not, is better, because they're not really interested in buying a $1 million life insurance policy that has 700,000 of cash value in it, because there's only 700,000. They've got to buy that and give you at least 700,000 because you already own that. And so there's really only 300,000 in that example that is at risk. And so lower cash value is better. Policies that have riders are also acceptable. The two that I show here, one is what we call an age 100 rider. It is a rider on a life insurance policy that guarantees the death benefit to age 100. An ROP rider is a return of premium rider. Also, those policy designs would be considered. For the most part, we want a company that's highly rated, at least B+ rated, and all ownerships can be considered from a sale perspective. So you can have an individual ownership, a trust ownership, an LLC or a corporation can own the policy and enter into that transaction. Now, there is a warning here. When someone sells a life insurance policy, let's say that you sell $5 million and you're going to take a different strategy from an estate planning perspective, that $5 million will impact your future insurability. In other words, if you apply for new insurance or replacement insurance on the application, it will ask you how much life insurance is in force on your life. You must disclose that $5 million is still in existence, even though a third party owns it. So there are some underwriting standards, and we want to make sure, I think you want to do your homework first to make sure that you are able to obtain, from a financial perspective, any replacement insurance, given the fact that someone else is going to own that original policy and it's going to stay in force. If you are a trustee on an irrevocable life insurance trust, which is very, very common, then you have certain responsibilities as a fiduciary. And one of them is that if, as a trustee, you are obligated to seek a buyer for any policy that you may want to surrender that's inside of that trust. If you want to surrender a life insurance policy in a trust and then distribute, let's say, the cash value to the beneficiaries, you are obligated to attempt to sell the policy, because potentially you could obtain more proceeds for the beneficiaries than might otherwise have been distributed. So just keep that in mind. If you're acting as a trustee, you do have that obligation to at least demonstrate that you have looked at a life settlement as a possible exit strategy for a policy. All right. A couple of very important questions you need to ask when you go down this road, working with an individual. You have the choice of working with a qualified professional insurance agent. As I said, in California, they need to be have the proper license and continuing education requirement. The only, outside of an agent, the only company that I'm aware of that does a big job at advertising is Coventry. I'm sure you probably recognize the name Coventry. They do print ads, they do ads on TV. You know, this very nice looking older couple, you know, with their grandchildren, and they're talking about selling it. So you can go direct to Coventry and talk to them, or you could use a broker. So a couple questions that you need to ask is, does the broker that you're using or the source that you're using to sell the policy treat it as a securities transaction? The reason that's important is that the requirements from a disclosure perspective are higher, and the standards when revolving around security sales in general have much higher standards than those that do not. So firms that apply higher standards to all forms of life insurance, whether it's term insurance or variable life insurance, for example, I think are important. You're going to make sure that you get protected through full disclosure for sure. Secondly, are the funding sources that the source that you're using institutional and licensed in the state in which you're domiciled? And so again, this is part of that Wild West statement I made. You want to make sure, who is behind this transaction. And they should be institutional buyers, and they should be licensed in the state in which you live. Number 3, does the company work with a number of different licensed settlement providers? In other words, is it a one-stop shop like a Coventry, or do they work with many different licensed settlement providers? Does the source negotiate through a written formal bidding process when you go to sell your policy? In other words, is there some sort of a competitive bidding environment, or again, is it just a one-stop shop? Is the compensation that you will pay uniform and capped? What I mean by that is, again, going back to my Wild West example, there's a lot of unscrupulous players where all sorts of backroom deals were made from a compensation perspective, undisclosed to clients, and that has been hopefully through regulation and oversight diminished. But you want to make sure that the compensation that you are going to pay on the transaction is fully disclosed, and everyone pays the same thing. It's not a special deal, or you're paying more or you're paying less. You want to make sure that it is uniform and that everyone is paying the same. Number 6 is, are both the offers and the total compensation fully disclosed? And I mentioned variable life insurance. Variable life insurance is a life insurance policy whose cash value is invested in stocks and bonds, basically. It is a securities by definition. And this FINRA notice applies to variable life insurance policies. As I said, an amazing amount of oversight is required when selling variable policies, and the individual has to also, that's selling it, be securities registered. So I think the important takeaway from here is know who you're doing business with, and make sure that you have as much disclosure as possible. So what are the funding sources? Who's buying these policies? And the answer are a lot of banks. There are a lot of banks buying them, along with hedge funds. So Royal Bank of Scotland, AIG, Deutsche Bank, Scottish, and Burdett are some of the largest ones that are pooling life insurance policies together, and they provide the funding dollars in which are used to purchase your policy, but they may not be the broker in which you are doing business with. Brokers can be different than funding sources. So, for example, companies like Life Equity, Coventry, CMG, Maple Life, they are brokers that get funding, or their source of their funds is from the previous slide, from those banks. So when a policy is sold, even though one of these brokers may be involved, the statements that come after that show the owner and beneficiary are in fact banks. And we've done more transactions than I can remember, and I know Wells Fargo's name is on them. I've seen almost every bank. They find their way to a lot of banks. Every state is different as far as how long you need to own a life insurance policy before you sell it. And the short answer is 2 years. So when you purchase a life insurance policy, the 2-year window applies to several other things, the suicide clause. And secondly, if you make any material misstatements in the application, for example, you don't tell them that you just had a heart attack, and you die within 2 years, they can rescind that policy. The 2-year window here is talking about you cannot sell a policy until you've owned it for 2 years. And there's a reason for that. There was a cottage industry early on, which elderly clients, especially in California and other parts of the country, would be approached by a life settlement agent, and they would convince that older person to undergo a medical exam, buy a life insurance policy, and literally the day after it's in force, it is then turned around and sold to a third party. So the agent made money, the client made money on the transaction, and the funder got a policy. And that whole scheme was called STOLI, S-T-O-L-I, stranger-owned life insurance. That is now, there's been legislation to stop that practice. And one way they do that is that you have to own it for 2 years. You have to be able to pay a premium for 2 years. So when you purchase a life insurance policy, the law requires whoever purchases it to have an insurable interest. The beneficiary has to have an insurable interest. And if that cannot be shown to exist, then an insurance company will not even issue a policy. So we've got 2 years we have to wait before we sell a policy. So once that you determine that you'd like to sell a policy or consider selling a policy, then how do we price it? And the pricing, the way we price policies is first, we gather medical information. That means that we go to your doctor and we gather medical information. You don't take a medical exam, anything like that. We just gather your medical records. Those medical records are sent to 3 life expectancy companies. There are 3 in the United States, the large ones. The life expectancy companies take your medical information, they review it, and they provide a report that says, this is how long we think you're going to live. In months, not even years, months. So if it's 10 years, it's 120 months. In this particular case, lower is better. Shorter is better, as you can imagine. A shorter life expectancy is better than longer from a pricing perspective. So once we have the life expectancy studies done, 2 are selected, the lowest 2, and then that information, the life expectancy information, is sent out to potential buyers. And in this slide, you'll see, I think there's at least 20 funders represented in this formal bidding process. So this is not a one-stop shop where you called Coventry and you did business with them. This went to 20 different funders, and including Coventry, by the way, and they are going to look at the same life expectancy information, and they are going to determine whether they want to bid on your policy. Every single funder has their own set of parameters they like. Some people, they like certain illnesses, believe it or not, or certain life expectancies, etc. And so what you will see is not all 20, I don't think I've ever had in my experience, all 20 come in and bid on one policy. They're very, very different. So in this particular example, you can see there are a total of 6 initial bids on this life insurance policy. And there were a total of 10 rounds of bidding. So the reason a bidding process is important is because it uses competition between these funders to determine at the end of the day, the highest possible price that your policy can garner in the marketplace. In this particular example, at the very bottom, you can see in 10 rounds, Magna Life Settlements was the winner at $532,000. And so if you decide to sell, that's who you would sell to, because they are, in fact, they provided the most capital for the policy. Once you determine what the value is and you've done a bidding process, the transaction does cost money to do. It is a financial transaction. And while there is some differential in compensation, it is becoming more standard in the industry. This may seem a little bit complicated, but there's a 3-tiered formula, which you're seeing on the screen now. 6% of the death benefit, 30% of the gross offer, or 1/3 of the value created, whichever is less. So if you sell $1 million policy, 6% is $60,000, and that is split between several different parties, and then you retain the balance of the proceeds. Full disclosure, I cannot overemphasize this. You want to make sure that whoever you are doing business with is fully disclosing upfront everything about the transaction, any conflicts of interest, how they are compensated, how your policy will be marketed, what rights you have. For example, our disclosure says that if you work with us and you decide not to sell your policy, but then you 6 months from now sell from someone else, you still owe us a fee. What we don't want, for example, is for us to negotiate the highest price for you. You write down that name, and then 6 months later, you contact that person on your own and you try to negotiate a deal. That's the kind of thing we don't want happening in this industry. It does happen, unfortunately. And so these disclosures are very important for protection on both sides. I think the expectations of both the buyer and the seller are documented up front, and it reduces any potential for misunderstanding or to know exactly how things operate. So we talked about a couple of the steps, so let's review them again. Number one here is understanding whether or not you're even interested in selling a policy. That's step one. Step two is evaluating what the potential value is. And we happen to use a process called a PAR, a PAR, a policy appraisal review, which is a high-level review of your policy parameters and then give you an estimated value, a range of value that you might expect to receive from your policy. If at that juncture you say that you want to move forward to the next step, then we initiate a settlement transaction, which means we formalize the process and we go to an auction, a formal auction. And we saw in the previous slide what an auction looks like. That particular example had 10 rounds of bidding. So step four then is generating and negotiating offers, and that can take weeks and weeks. The longest one actually was over 20 weeks, about 4.5 months of bidding back and forth, 4.5 months. So it is not something that happens, each round isn't one day, it's weeks at a time. At that point, we receive the final and best offer, and then you have a decision to make. So there's several points of decision making along this line, at any which point you can exit and change your mind. So once you decide, okay, I'm going to accept that offer, and the decision is to move forward, then you move into a closing process, which is similar to the closing of a piece of real estate. I mean, the documents are this thick, there's a notary involved, and it's a pretty arduous task. We have a notary come and visit you, and you sign all of these documents, and that protect you and protect the buyer of the policy. Once those documents are signed, the funds, the purchase funds, are put into an escrow account and held there until the new owner, the institution that bought it, formally changes the owner and beneficiary designation on the records of the insurance company. That's the last step. So they will send in an owner and beneficiary change. Once the insurance company acknowledges that that change has been recorded, then the proceeds are wired to you. Even at that point, in the state of California, you have 30 days in which to reverse the transaction. So California especially has a lot of controls for sellers. Lots of different ways along here that you can exit and change your mind. And I would say that of all the transactions I've been involved in, probably 1 out of 3, at some point in this process, they elect not to sell for whatever reason. And that's okay. We go through the process, and enough policies are going through the process that 2/3 decide to sell, 1/3 does not, I would say, on average. So let's take a look at some actual case studies of people that have sold policies. What do they look like? So number one is, I mentioned before, premiums are no longer affordable. So here's a quote. I received a notice from my insurance company that my policy was a month away from lapsing. And in order to keep it going, I'd have to pay 5 times more than I was paying. I plan to let it lapse because I couldn't afford the premium. I think Paula will agree. This unfortunately happens. And it's not a letter that you want to receive, but it happens. And so the policy was a $2 million universal life policy. Premium was relatively low at $6,300 a year. They wanted to move it to $33,000 a year. That policy, that premium would extend the coverage from her age of 74 out to age 100. There was really no cash value. The original offers that came in were 200 to 250,000. After 16 rounds of bidding, 511,000 was the final amount of proceeds that were received, gross proceeds. Now, remember, these life insurance company or funders, the buyers of these policies, are going to use a premium that is $33,000 a year, because no matter what, they are going to make sure that that life insurance policy ends in a death claim without question. They're going to pay whatever premium is necessary, and they are going to make sure that it results in a death claim. They are buying lots and lots of policies, and some of the people will die sooner than expected, and some will die later than expected. And what they're looking for, from a pool perspective, is about a 7% return on their capital. Here's a sample of a trust-owned policy. There's insurance and an irrevocable trust to cover future estate taxes. The trust was running out of liquidity to keep the policies. In other words, gifting was not available. So selling one policy created liquidity to keep the other policies going. This individual happened to be 90 years of age. There was a $4 million policy in that irrevocable trust, along with others. Premium was $30,000 a year. That premium needed to go to $312,000 to extend coverage from age 90 to age 100. And at the end of the day, $1.4 million was received in the irrevocable trust for the purchase of that $4 million. That $1.4 million then was used to pay the premiums on the remaining insurance inside of that trust. So it solved the problem of the lack of liquidity. The next one is business-owned life insurance. This is a policy, a key man policy on a CEO. That policy was no longer needed upon retirement. It was a very large policy, 7.2 million. Premium was 72,000 a year. Didn't want to keep it. There was really not much cash value in there. The client would have received $12,000 had they surrendered it. Premium to keep it was sizable, 169,000. That client ended up receiving 437,000 gross proceeds after 24 rounds of bidding, and then walked away with those proceeds. Lastly is a bit of an outlier, and it has to do with health. As I said previously, you really have to have today certainly less than 14 years life expectancy, and 10 or less is even better. However, I have sold policies, and occasionally there are buyers that want to purchase policies on healthy elderly people. In this particular case is an 81-year-old female, $2 million of universal life, a relatively high premium at $90,000. She had a relatively long life expectancy, 13 years, which would be a little bit longer than desired. We ended up getting gross proceeds of $210,000. And I have sold, I think the largest one was a $10 million policy on an individual. It was actually term life insurance on, it was a policy that was used on a buy-sell agreement, and it was no longer needed. And this person was in great health. And there was a funder that came and said, hey, I want to buy it. I think the proceeds were under $100,000 to the seller, but the seller would have received zero. Instead, they got $100,000. So occasionally that happens. It is a bit of an outlier, but I always tell clients that they should at least get a policy assessment review, a PAR, if you will, and to see if there's potentially any value. So that's those are the examples, and I'm going to close with, again, a timeline. It's important to set expectations. There's a lot of steps. I've gone through them. I try to tell clients 4 months. 4 months is typical. It can take as long as 6 months, but 4 months is typical to go through the entire process. And I think the expectation is important because people tend to get frustrated if it's not moving fast enough, but it is a long process. And at that point, I think I'm going to turn it back over to Paula and see if we have any questions that people might have. Let's go put it back to Paula.
Thank you, Mark. That was very informative. Yes, we do have a couple questions. The first one is, will I have to pay any fees associated with the life settlement, or does it come out of my proceeds?
Will I have to pay any fees, or does it come out of the proceeds? It comes out of the proceeds. So the offers that are shown in my slide presentation are gross of fees. So the fees are taken from the gross proceeds. There is a potential, however, that an insured will have to pay a premium. What I mean by that is that if a premium is due on a particular date and the transaction has not closed yet, then the client is responsible for that premium and to make sure that they get the policy paid through into the closing period. In certain cases, a buyer, we can negotiate that an insured or an owner will be refunded that premium. But I would say there is no out-of-pocket expense to the seller other than making sure that the policy is in force at the time that the transfer occurs, which could mean they have to pay a premium.
Okay, great. And that leads me into the next question we have is, do I still owe premiums after the policy is sold? When do the premiums stop being required?
The answer is absolutely not. Once the owner and beneficiary change is recorded and the proceeds are wired to the seller, that's it. You will never, as a seller of a life insurance policy, 20 years ago, when the first transaction was done, clients were very nervous about it, looking over their shoulder like, mafia is going to come in and take me out on this thing. Today, I really don't get that because it's more mainstream to sell your life insurance policy. But actually, a seller will never hear from the buyer again in their lifetime. Now, there is a requirement after sale on a regular basis for a person or persons to validate that the insured is still living. So we get every year for policies that we have sold emails from banks that now own these policies saying, is this client still alive? Do you know if they're still alive? So we get that, but the client will never be contacted. The seller will never be contacted again and will not pay a premium.
That makes a lot of sense. And the last question we have right now is, does there have to be a certain face value on the policy? How do you determine if this is an ultimately good thing for you?
The minimum face amount, as I said, is $250,000. Absolute minimum. And what was the second half of the question?
To determine whether it's worthwhile to do a minimum.
Yeah. Well, the only way you're going to determine whether it's worth it or not is to do a preliminary analysis of health. What does the person's health look like for life expectancy? So, as I said, if the person's life expectancy is 15 years and under, then there's a potential that there's value. 10 years and under, I would say absolutely there's value. The amount of value will be determined by a professional that knows what they're doing and knows how to price these and will give a preliminary assessment of the range of value. But we won't know the exact value until it goes to market and the competitive bidding process is utilized to come out with the best and final offer.
And to do that life expectancy, is it a normal exam? Like if you were applying for life insurance, blood, weight, they may look at your medical records type of thing?
Actually, there's no exam required. There's no exam. The way they determine life expectancy is they receive a HIPAA authorization signed by the seller so that the life expectancy company can gather medical records only. So they would write, for example, to a person's general practitioner, to their cardiologist, to their oncologist, and they would receive records and they would just simply review those records. It happens behind the scenes. The seller is not involved other than to sign the HIPAA form. And the next thing the seller is apprised of is how the life expectancy study came out.
Okay, great. That's very helpful.
Yeah.
Well, this concludes our presentation. If you have any additional questions, feel free to reach out to either Mark or our office at the email addresses on the screen. And we will be posting the recording on our website at mrclawcorp.com, as well as our YouTube page. And Mark will be posting it on the Prosperity Partners website and YouTube page as well. Their website is prosperity-pwm.com. And please mark your calendar for the first of our two-part series coming up, What to Do When a Loved One Dies. Part 1 will deal with administering the trust, and that will be held October 9th at 12 p.m. And part 2 being the probate of an estate's, a loved one's estate, which will be October 16th at 12 p.m. Thank you for joining us, and thank you, Mark, for a very informative presentation. Have a wonderful day, everyone.
Thank you, Paula.